Hello friends, this is Jake. Welcome to my channel. In this video, we will talk about converting active income to passive income. By the way, please subscribe and drop a like. In the previous video, we spoke about 3 ways to create income. To summarize those 3 methods, the first one was selling locally. You can sell on OfferUp or on Craigslist or Facebook Marketplace, eBay, any selling platforms that you can find. Also, if you want to watch the video that I just mentioned, you can watch in the above link. The second method that I mentioned was related to gig jobs like driving for Uber or Lyft, Uber Eats, any of those gig jobs. And the third method was investing in stocks or ETFs that bear dividends. When we analyze all these 3 methods, you'll find that the first 2 methods is tied to active income and the third one is passive income. So why active? Because those first 2 methods of creating income requires your physical presence. You're trading your time for money. So when you're selling locally, you would need to list a few items, and the maximum you can list honestly is maybe 20-30 items, because you have to interact with customers, give counter offers, and finally sell. Also the same with Uber and Lyft, Uber Eats, you're trading your time for the money. So those are active streams of income. And investing in dividend bearing ETFs and stocks is passive, because once you invest, there is nothing that you have to do other than adjusting your portfolio once in 6 months. It depends on your portfolio type. The first 2 methods are not really scalable. So what do I mean by scalability? In the first 2 methods, there is only so much money that you can make, because you only have 24 hours in a day, right? And if you consider full blown crazy amount of hours, let's say you can work for 20 hours, there is an income cap that you can make from Uber driving for 20 hours. So those jobs are not scalable. The same with selling locally, there is a limit. So the third method, where you invest in stocks, ETFs or bonds which bears dividends, there is no income limit. You'll always get a percentage out from your investment. So if the average portfolio dividend yield that you get is, let's say, 5%, if you invest $100, you'll get 5% of that. If you invest $1,000, you'll get 5% of that. And if you invest 100,000, you'll get 5% of that. So there is no limit to your income potential. Also, there is the compounding effect. Here I will refer to not just this regular compounding calculator. You can Google for DRIP, that means stock dividend reinvestment plan. This is where you invest in a stock or ETF, you get a dividend, and you put that back into the same stock. So it's like a circle. So imagine you invest $100 into a stock or ETF which bears 5% yield after 1 year. So you have $100 in your stock. Assume that the stock price did not change, and you get 5%, $5 in dividends. And that with that dividend, you can invest that $5 back into the same stock, right? So the following year, you earn interest on the first $100 and also another 5% on the extra $5, right? So it compounds. So in this calculator, I have put some arbitrary numbers, right? And here the underlying assumption is you make $100 a week extra. So you have a regular job and you're making $100 extra every week by selling things locally or by driving for Uber or Lyft. So I'm assuming 4 weeks, you're going to do that job, and so you earn $400 the first month and you invest that, and every month you invest another $400, right? Because you keep on doing that job. And let's say you buy a stock which is worth $50 right now, and you expect that stock price to increase 1% annually, and we'll invest for 20 years and we'll keep 5% dividend yield. So there are a lot of ETFs and stocks that you can buy which gives 5% yield, and I'll put the expected dividend growth rate as 2%, so the companies increase their dividends. Also, let me put the expected increase in stock price 4% annually. So these are all kind of conservative numbers. You can create a portfolio where it can mimic these numbers. So let me calculate the returns, and after 20 years you will have $209,000, right? And what did it do? All it did was do this for 20 years. And if I increase these numbers, so let me assume that you also put some money from your regular job into this. So now the assumptions that we are taking is you are making $400, you deposit $400 to your brokerage, and then you make monthly contribution of $1,000, which includes $600 from your regular income, and invest $400 that you make monthly from your extra side gigs, right? You expect 4% growth in your stock, you expect a 5% dividend yield, and you expect a 2% growth for the dividends. And when you calculate it, you get $520,000, $500,000. So just think about it. In the grand scheme of things, $500,000 would not sound enough money to retire, but that's not the point, right? Let's say someone who is 20 started doing this, so he'll have this much money in his account when he's 40 years old, right? Think the following year, the 21st year. In the 21st year, think he's going to get a 5% return of that 520. That's approximately $27,000 a year, right? That's almost like half the salary that you make from an average job in US, right? Think of the possibilities of that $27,000 can bring to your life. So that is the power of dividend reinvestment, the compounding effect. Now let's take a real example. The ticker symbol is O, Realty Income. So this is a favorite of many income investors, dividend income investors. This is a real estate company, and they have been consistently giving dividends over the last 50 years. So if you look at the market cap of this company, it's 21 billion, so it's a big company, and it's valued pretty rich. If you look at the price right now, it's still quite high, but this is a pretty reliable company, and you can create a pretty sizable income from having this in your portfolio, Realty Income. There are many other stocks and ETFs. For example, you can have a mix of emerging market bonds. So those are you're investing in bonds issued by emerging governments. Some of them give you 5 to 6% dividends. So there are plenty of options. There are a lot of combinations that you can make too, right? You don't have to do the drip. For example, you can get this dividends, and then you can invest those dividend money in a high growth company like Facebook, or even Microsoft, or any other high growth company that you think is going to grow. So there are plenty of options when you invest this way. So in conclusion, the idea that I want to get across is, wherever you are in your life, if you start today, you can make a sizable difference in your future life. The point is, you have to start today. If you start today, you can, like you saw on the screen, that 20 years starts from today. If you start next year, well, it's going to take 21 years. So the best time to start is today. So if you would like another video on setting up a dividend portfolio, please let me know. I'll create a video on the topic. So that's all I had for today, folks. Stay safe, stay awesome. Bye.